The Nasdaq market is currently closed, with Opendoor Technologies Inc. Open settling at a closing price of $7.69 per share on Monday, November 24, 2025. This figure represents a remarkable daily gain of approximately 15.56% from its previous close, capping off a highly volatile but explosive run for the iBuyer stock. The general market expectation for Opendoor has long been one of skepticism, largely owing to its capital-intensive business model that is exceptionally vulnerable to interest rate shifts and housing market cycles. However, what most investors likely missed in the lead-up to this recent jump is a deeper operational shift coupled with a highly technical trading signal. The stock didn't just move on housing tailwinds, which is the surface-level explanation you will find everywhere. It experienced a massive volume spike. We're talking about trading volume in the hundreds of millions that points directly to a forced mechanical move related to short positions and recent complex corporate actions, specifically the special dividend distribution of tradable warrants announced recently. This detail completely changes the narrative from a simple housing market recovery story to one of a potential systematic unwind in bearish bets that is actively fueling the upward momentum. The common ground narrative is that Opendoor is a binary bet on the housing market, a highly speculative creature of the COVID-era housing frenzy that got decimated when interest rates soared, leaving them holding a costly inventory bag. This is mostly true, and their business model, using technology to quickly buy and resell homes, essentially acting as a market maker for residential real estate, does make them highly sensitive to holding costs and market deceleration. Yet, the contrarian take here is that the market is beginning to price in the successful execution of two key strategies: aggressive operational efficiency and a pivot toward an asset-light, partner-backed model. The recent quarter's results, while still showing a loss, demonstrated a noticeable improvement in contribution margin per home and a reduction in overall fixed operating expenses, suggesting that the painful right-sizing of the business over the last year is actually starting to gain traction. The core question is whether these efficiencies can outpace a potentially stubborn high interest rate environment, and for the moment, the market momentum suggests that a critical mass of investors believes the worst of the inventory risk is now in the rear-view mirror. Drilling into the recent stock movement, the sheer velocity of the move, which has seen the stock price return over 200% year-to-date from its 52-week low, cannot be explained purely by fundamentals. The stock's dramatic intraday swings and high volume are typical of short squeeze dynamics mixed with retail excitement. We've seen this script before, and Opendoor's recent inclusion in certain S&P indices also helped institutional money flow into the name, providing a structural lift. The trading volume itself has often been more than double its average daily volume in recent sessions, which is a strong sign of institutional repositioning, both long and short. This intense activity also coincided with the recent news of the interim CFO selling shares, which naturally raises a flag for investors concerned about the C-suite's confidence, even if the sale was pre-planned or for personal reasons. In the current market, any insider sale during a rally is viewed with maximum scrutiny, adding another layer of volatility that traders are actively trying to capitalize on. The business itself is straightforward. Opendoor buys your home for cash, handles the work and hassle, and then resells it. Their technology advantage is supposed to be superior pricing and prediction models, allowing them to turn over homes quickly and profit on the spread, with additional revenue from ancillary services like title and mortgage. The reality, as demonstrated in 2022 and early 2023, is that the model breaks down when inventory sits for too long, as carrying costs erode profit, turning what should be a quick trade into a painful loss. They reported an immense net loss in the past fiscal year, which is why the stock was trading near $1 earlier this year. Their pivot now centers on minimizing inventory risk through stronger partnerships and a reduced fixed cost base, effectively moving toward a slightly more traditional brokerage hybrid model while retaining their core cash offer service. The next few earnings reports will be critical not for absolute profitability, but for a continued trend of positive unit economics, where the gross profit per home is consistently moving in the right direction. Old reports show the historical issue wasn't revenue generation. They can buy and sell houses, but profitable buying and selling, a distinction the market now understands deeply. Now, let's address the elephant in the room that is driving much of the recent price action: short-selling awareness and pressure. Opendoor has been and remains a heavily shorted stock. The latest available short interest data shows that over 163 million shares are sold short, representing a short interest percentage of the float sitting around 27.10%. This is an elevated figure that screams potential for a short squeeze under the right buying pressure. The days to cover ratio is low around 1.34 days, which might suggest a quick cover is possible. But this metric is highly influenced by the recent massive trading volume. The borrow fee rate, the cost for short sellers to borrow the shares, has remained relatively low, around 0.5% or less, which is unusual for a heavily shorted stock experiencing a surge. Typically, a massive short squeeze is preceded by a spike in the borrow rate, indicating high demand for the shares to short. The fact that the rate is low suggests that while the absolute number of shorted shares is high, the supply of shares available for lending hasn't entirely dried up, meaning the short pressure remains structurally available and could easily reassert itself. However, the recent announcement of a special dividend of tradable warrants has been a complicated headache for short sellers, who are now mechanically obligated to provide these warrants to the lenders of the shares they sold short, adding a forced covering or hedging component to their risk profile that has likely contributed significantly to the recent buying volume. This is not a simple short squeeze, it's a systematic short-related headache. Actionable insight for investors watching the short side of this: don't just look at the short interest number. Monitor the daily off-exchange short volume ratio, which is currently sitting above 31%. This indicates that a significant amount of short selling is occurring in dark pools, which is a common strategy to mask supply and prevent a panic-inducing spike in the regular exchange price. The low borrow fee rate is the key signal to watch next week. If the stock continues to climb and the borrow rate suddenly spikes above 5% or 10%, it would be a flashing red light for an impending more violent short squeeze as liquidity for shorting dries up. Retail traders on Reddit and X have certainly noticed the high short interest and are actively discussing coordinated buying efforts, comparing it to earlier meme stock situations. This social media chatter provides a psychological floor, but it's the institutional obligation related to the warrant dividend that is the current mechanical catalyst. In terms of future outlook, there are a few primary scenarios. The bullish case hinges on two things: a continued, albeit gradual, decline in mortgage rates, and Opendoor successfully demonstrating consistent profitability on a per-home basis, proving that their updated pricing algorithms have mastered the current market conditions. A minor cut in the federal funds rate could immediately translate into a significant reduction in their holding costs and a quicker sales velocity. The risk, of course, is a recession, which would freeze the housing market and leave them again exposed to inventory risk, or an inability to maintain their gross margin improvements. They have a substantial market cap, so the expectation of a quick flip back to profitability is high. But the reality is that consistent positive cash flow may still be a year or two away, particularly with a possible slowdown in home buying heading into the year-end cycle. The fact that many Wall Street analysts have price targets drastically below the current trading price, some even below $3, underscores the deep disconnect between the trading reality and the fundamental expectation. This gap is the volatility investors are trading. The median analyst target remains very cautious, suggesting that the recent price action is almost entirely detached from traditional valuation models and fueled by technical and short cover dynamics. Comment below how many shares of Opendoor you currently hold, or if you think the market has completely lost its sense of reality regarding this stock. What's your take on the rising short interest, smart money, or manipulation that is now backfiring? Ultimately, the Opendoor story is a classic tension between expectation and reality. The expectation is that this is a failed tech model waiting for the housing market to fully recover, and that the recent pump is purely speculative noise. The reality, which is why the stock is moving, is a nuanced combination of a legitimate, albeit slow, operational turnaround combined with an active, systematic unwinding of institutional short bets due to corporate actions and technical momentum. The retail investor is caught in the middle, leveraging the technical pressure to drive the price while betting on the eventual success of the strategic pivot.